The Ukraine Peace Summit has wrapped up in Switzerland.
80 countries have jointly agreed that the territorial integrity of Ukraine must be the basis for any peace agreement to end Russia's two-year war. The agreement was confirmed in a signed document by some 80 nations at a Swiss conference. On the final day of the two-day conference, Ukrainian President Volodymyr Zelensky said he was confident that the peace effort would continue.
Keep their interest to host the second peace summit.
However, despite attending, some key developing nations did not sign the summit's communique. By Karen Channel.
Russian media reports that security forces stormed a detention center and killed inmates accused of links to the Islamic State group. The inmates had taken 2 staff members hostage. News and analysis at townhall.com.
Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Monday as we start a mid-month run into the end of the month. June almost over here. This is a holiday shortened trading week, by the way. Juneteenth falls on Wednesday, I believe, so the markets will be closed on Wednesday. So we'll have trading today and tomorrow, Thursday and Friday, but it's a holiday shortened week. So because of that, trading volume will probably be fairly light. We'll see what happens over the course of the week. But of course, we're getting right now into really kind of the summer of, when July really kind of gets started here. That'll be the beginning of the next quarter's millennial earnings season, where, we're going to try to beat those estimates that we do every quarter. But also, we're kind of getting into the heat of summer, which, and normally what happens is, of course, August. Most of Europe shuts down, so trading volume starts to lighten up a bit starting in August. While June and July tend to be better months, August and September tend to be a little bit weaker months in terms of performance. But this is why, historically, when you go back and look at the summer trading months between May and October, those are your lowest return periods of a year. So again, we have our seasonally strong period, which runs from really November through May, and then from June to October is basically weaker trading months of the year. So that's where the old adage comes from: sell in May, go away, come back in October. So, we'll see what happens. Last summer, sell in May, go away certainly worked well with the market having a 10% correction. Right now, markets are doing very, very well. And at this moment, it doesn't seem like sell in May, go away will work. But remember, the market didn't sell off last year until July. And then between July and October, we had that 10% correction. Will we repeat that this year? Nobody knows for sure. But there is some historical tendencies that in election years, we've talked about this before on the show, that markets do sell off in the month or two ahead of the presidential election, just simply because you don't know what policy is going to be. Who's going to win? What's that going to mean for policy? Higher taxes, lower taxes, whatever. So Wall Street typically tends to de-risk a bit later in the summer, heading into that presidential election. Will this year be different? Who knows? We never know. But if we go back and look at historical tendencies, statistical norms, those type of things, that's what happens. So you can kind of manage your risk from there. This year may be, who knows what's going to happen this year. We've got a highly contested election coming up. Who wins and what policies are going to be implemented before or after. If Joe Biden wins the presidency, that's one type of policies, maybe higher taxes. If Trump wins the election, potentially lower taxes. So again, all these type of things, are going to kind of be weighed by the markets as we get closer to that election in November. Outside of that, of course, economic data has continued to weaken. We had the University of Michigan Consumer Sentiment Report out on Friday. Big drop in sentiment all of a sudden. Kind of sentiment was kind of creeping up, but, and improving. But on Friday, that over the last month, consumer sentiment dropped very sharply, and there were big drops in expected rates of income over the course of the next year. Outlooks for a better financial situation took a tumble on Friday. And again, this just happened in the last month. It was like all of a sudden, consumers just kind of hit the wall. And, what was improvement just completely kind of deteriorated. And this kind of jives with some of the economic data we've seen as of late. Over the last couple of weeks, we've talked about, in the newsletter in particular, the Bull-Bear report, we've talked about weakening economic data. All of a sudden, unemployment rates ticking up to 4%. We're starting to see some of that implication that the economy is indeed starting to kind of hit the brakes here. And again, that's getting translated over into the inflation data. Of course, last week we had the CPI report, the PPI reports. Also, import prices took a big decline. So certainly disinflationary pressures are creeping in as the economy does seem to be slowing down. But again, that University of Michigan report was very interesting because all of a sudden consumers went, I'm done. And it was a very big drop very quickly. But this is something we've talked about for a while, is that consumers have been, hanging in there and spending a lot of money, going further into debt. They had income coming in from savings. Those are all now getting depleted. And we may have just hit that point. Now, again, it's too early to tell. It's just one report. It could be an anomaly, and next month sentiment jumps right back up again. We'll see. But if this is indeed, a trend change, then we may have hit that point to where all of a sudden consumers have kind of hit the ropes in terms of what they have in terms of the availability to spend. And again, higher prices for goods and services, those type of things, certainly are weighing on the consumer and their spending patterns. Okay, but outside of that, that's what's happening over there. On the other side is the stock market, which is doing great. So again, nothing really alarming or new here. Of course, as we talked about last week, we have just continued to kind of grind along this 20-day moving average. And again, absolutely nothing seems to be wrong here. Markets are back to very overbought conditions. And again, last time we were this overbought was just before we had that correction back to the 20-day moving average again. And that worked off, some of that overbought condition. Then we rallied back up. And again, as we kind of talked about here, upside has been limited. We're making some small gains. Markets are kind of grinding higher, but they're not just running off to the moon at this point. But we are very deviated once again from that 20-day moving average, very deviated from the 50-day moving average. And in these kind of deviations, as we saw, previously, can't last for a long time. And again, we're fairly deviated from these longer-term moving averages, which you're eventually going to kind of get that corrective action just to relieve some of that overbought condition. And again, we're very overbought, just like we were, just a couple of months ago. So again, this is, as we talked about before, again, nothing to be overly concerned here, but do expect a bit of a pullback here just to kind of let markets reset themselves, kind of in this phase. This has been a very narrow rally, as we've talked about previously. If you take a look at performance of the top 10, really the top 3-4 stocks versus the rest of the market, there's a big gap in performance. And last week in particular, while the market was making, kind of these all-time highs last week, you had very, very narrow breadth in that rally. When you take a look at across the market of the S&P 500, most of the stocks were not making new highs. And in fact, we have more and more stocks in terms of, their trading that are not trading above their 50-day moving average, more and more stocks not trading above their 200-day moving average, even though the market itself is doing that. Again, that's that narrow breadth that we've been talking about for a while. And again, that narrow breadth does not mean, by the way, that the markets are going to have a big correction at, any moment. It's just a function of the fact that we have fewer and fewer stocks because of their weighting in the index that's pulling the index higher. So when you take a look at your performance in your portfolio, it might not be doing as well as the market because you don't own just 3 or 4 stocks in your portfolio. You have these other stocks that are not as performing with the markets. In fact, in a lot of cases, these stocks are underperforming across the board. But we're back to that kind of phase where, again, we've got this chase for the largest stocks that are generating the earnings growth. We're getting ready to head into the end of the quarter, so we're going to have quarter end rebalancing coming up for portfolios. So there's a lot of managers that are going to have to buy these stocks going into the end of the quarter to get their weightings where they're supposed to be when they come out with their quarterly report. So again, nothing says a big decline's coming, but pay attention to breadth. It is important, and it is getting weaker. Okay, that's what you need to know before the bell this morning. When we come back, we're going to talk a little bit more about inflation. Also, James Grant, who was the interest rate observer, recently came out talking about why interest rates are going to be higher for much, much longer. We'll talk about his theory and whether it's valid or not when we come back from the break. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So Welcome back to the show this morning. A few things to get into today. First of all, congratulations to Sharp's Law in our chat today, having their 26th wedding anniversary. It's a feat. That is quite the accomplishment. Congratulations on that. So a couple of things, as we kind of talked about in this past weekend's newsletter. I also want to get into a little bit about interest rates this morning because it all kind of plays into the same thing. Inflation came in a lot weaker than expected last week. Friday, import prices dropped a whole lot more than expected. And again, as import prices drop, that means that the input cost into the manufacturing side of the equation or services, if I'm, using some, product or service that I import into whatever service I provide, cleaning, whatever it is, then my cost of input has come down. So that increases profit margins temporarily until, my business starts to slow down, then I have to cut prices. So, this is kind of that disinflationary trend that we're seeing come through the data. And this has been coming on for a while. But again, things are still elevated, right? Inflation has remained stickier than what many expected. And there's some reasons for that. And we're going to kind of go through that this morning. But again, we have to look at, when you take a look at, a chart of GDP and inflation and PCE, personal consumption expenditures is 70% of the economy, right? So that's where that comes from. And, so now PCE prices are very volatile. So in order to smooth out that volatility, we kind of use a bit of an average to smooth the month-over-month changes in the personal consumption expenditures price index. But what you see is a very high correlation between the ebbs and flows of economic activity, inflation, and PCE. And that makes complete sense because, again, 70% of your economy is driven by consumption. So goes consumption, so goes prices. Because if I don't have the demand for something, I've got to lower my price to sell it. So prices fall, inflation comes down as economic growth slows. And again, we're still in that process. Inflation's coming down. It's tracking the decline in GDP. But we're still very elevated from where we were from long-term means because of that $5 trillion that we went shoving into the economy. It just created this big, deviation from the norm. So it's just going to take longer, as we talked about before, to return back to normal trends. It's just, if you just kind of think about, you have a balloon that you blow up as far as it will go, right? And to deflate that, it will take longer to deflate a fully inflated balloon versus one that's only halfway inflated, right? So we just did this massive inflation of the economy. It's just going to take time to work that out. And so, but that's going to come because, again, wages aren't keeping up with inflation. And if wages aren't keeping up with inflation, then individuals have to tap into their savings or their other items in order to make up that difference. So they got to tap onto debt to deplete their savings because and if you take a look at wage growth, it's clearly starting to decline. And more importantly, not only is it declining, it's not then that the difference between the blue and the red is whether or not it's outperforming inflation. And so in other words, wages are not keeping up and have not been keeping up with inflation, which is why we're seeing more and more consumers go further into debt, deplete their savings, et cetera, because they simply just have no other choice. And so, when you look through the inflation data, you're starting to see that decline. Rental income, which is 44% of the index, is still coming down, but it's not coming, again, it's just taking longer for that to come down and there's about a 10-month lag. 9-10-month lag on the homeowner's equivalent rent before it actually shows up in the CPI data. So again, you've got a very big component of the CPI index that's going to continue to decline over the course of the next few months, and so that'll come. But again, the important thing is that ultimately inflation is coming down, but again, it is remaining sticky. And one of the reasons that it's remaining sticky is that there were several things that we didn't count on initially, didn't factor in initially. Same thing with most everybody else. because there were some things happening kind of behind the background that it just took longer to show up. And we talked about before is that, back in 2022, everybody was expecting a recession. We said, no, we're not going to have a recession here because of the Inflation Reduction Act, the CHIPS Act. That's shoving extra money into the economy. That's going to help, keep the economy elevated for longer. The other factor was money market funds. You had a huge chunk of assets because people were given all these stimulus checks. There were money market funds, and then the Fed hiked rates. And so all of a sudden, households were getting extra income from money market funds, buying T-bills and getting a 5% return. So they had all this extra cash coming in. And that's billions of dollars. And so when you take a look at a chart of money market funds and that interest income, you have this extra income that was coming into households for them to spend. Now, they're bleeding a lot of that excess savings down. And unfortunately, that's happening really kind of across the board. But the bottom 80% of income earners have pretty much depleted all those savings, and so they're and this is why we're starting to see a downturn in consumer sentiment, et cetera, because they've kind of hit that wall. All those excess funds have really run out. And when you take a look at money market funds, kind of broken down by who owns them, it's really corporations that own a vast majority, and that's that big, massive blue section in the middle of this chart. By the way, all these charts, if you're driving to work this morning, you can't see these charts. It's okay. They're in this weekend's newsletter. So if you go to the website, realinvestmentadvice.com, just click on the Bull Bear Report. It's the newsletter link in our Insights tab. But all these charts are there for you. So you can go back and look at it. But I'll explain all this is that there's this massive, when you take a look at the breakdown of who owns money market funds, retail investors own very little of those. Now, they do have money in savings, and I'm not going to deny that, but it's a very small amount of money. So you hear people talk about, there's $6.5 trillion in money market accounts. Warren Buffett owns about 5% of the T-bill market all by himself because of the massive amount of cash that he has sitting on his books. That's most corporations. The vast majority of that $6 trillion is owned by corporations. There's a very small percentage owned by retail investors, very small percentage owned by institutions, et cetera. Vast majority of that's corporations, pension funds, those type of things. So they hold a lot of cash, and that's generating a lot of excess income at 5%, 4%, whatever they're getting on it, onto their books. So this is another reason that incomes remain high. Employment is still doing okay right now, but we are starting to see that begin to kind of pick up here. So you see this chart a lot. And we're going to talk some more about this in a minute, but you'll see this chart a lot comparing the 70s inflation versus today. And they do this overlay that looks like this, where you have the inflation run that we had back in 21, 22. And that's declining and starting to base here a little bit. And so a lot of people go back and immediately compare this to the 70s. And they go, see, this is why there's going to be this massive surge in inflation again. And inflation is going to come roaring back because that's what happened in the 70s. We're going to go through this in the next segment. But kind of looking at that this time is not last time. There's massive differences. And this is, the faulty analysis that kind of comes from the media in general, because they say, well, this happened before, so it's going to happen again. There's a lot of differences that, of what happened back then versus what happened today. We were much more oil centric back in the 70s than we are today. And we'll kind of go through all these in a few minutes, because this is going to kind of go along with James Grant's outlook for interest rates as well. But one of the big drivers between today and the 1970s is full-time employment. When you take a look at full-time employment versus the population ratio, and again, so how many full-time employees? Now, full-time employment is very important because I've got to have a full-time job in order to pay bills, raise my family. That's tough to do on part-time jobs, right? I can have 2 or 3 part-time jobs, but I don't have benefits. I don't have these other things. And so back in the 50s, 60s, 70s, we had a rising trend of full-time employment relative to the population, versus since 2000, our full-time employment relative to the population has been on the decline. And this has a lot to do with demographics, has a lot to do with the change in the labor makeup of our markets, has a lot to do with the debt and other things that are going on. But there's a very decided change in activity. And again, back in the 60s, 70s, and 80s, that rising trend of employment led to more money to spend. People had incomes, they could support their families. And so even though you had higher inflation, they had wages that were keeping up with that inflation run. That's just not the case today. So again, very different periods between the 1970s and today. And I understand why there's a lot of comparisons. But again, it's just and again, we'll talk some more about this in a few minutes, but there's just very different makeups as to what happened in the 60s and 70s and the 80s versus what happened today. And again, the big thing between then and today, of course, is the debt. And not just government debt, but household debt as well as corporate debt, etc. We just have so much more debt today than we had back previously, where we had more dollars going into productive investment versus non-productive payment of interest expense. All right, quick break. We'll come back. We'll talk a little bit about James Grant. He just had a interview recently talking about rates are going to be higher for much longer. We'll talk about his views and what the economic data actually says about that. Don't go away. More of that coming up right here on the Real Investment Show this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So there's a whole big food discussion going on in our chat channel right now. Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
The Real Investment Show podcast.
I disagree, because at Slotsky's not only can you get a chocolate chip cookie, you can also get a hot cinnamon roll.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and buns.
But you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon
at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, last week, James Grant did an interview and had a very interesting outlook. And he was asked for his outlook on interest rates. And obviously, this is the big topic of debate as of late. You know, interest rates are going higher, they're going lower, where they're going. Because that has a lot of implications, right? Higher interest rates hurts homeowners that want to buy a house. Higher interest rates hurt consumption because borrowing costs go up. So higher rates, not great for the economy. So during this interview, basically James Grant stated that he sees interest rates moving in a cyclical pattern, potentially rising for another multi-decade period. He based that view on historical observations that there is that rather than this kind of mystical belief in cycles. He says that finance has shown a cyclical nature, moving from extremes of euphoria to revulsion in various asset classes. Therefore, he proposes that persistent inflation, increased military spending, and significant fiscal deficits could drive rates higher. So, essentially, his debate his point is that interest rates are going to go higher because they've been low for so long. And that's kind of akin to saying that the Atlanta Falcons have not won a Super Bowl in 58 years. So because they haven't won a Super Bowl in 58 years, they're now going to win the Super Bowl for the next 58 years. And, they're going to become the next great dynasty. And that's just not the way things actually work. And particularly in the interest rate, and particularly when it comes to interest rates. Because interest rates, now, equities are a different thing, right? Equity prices are driven by sentiment. And, if markets are going up, people pile into interest rates and they drive they pile into equities and they drive equities higher because that's momentum, right? It's all about psychology. The interest rate market, the bond market, very different, right? And we've talked about before is that if I'm going to loan money to somebody, I'm locked up for a certain period of time. I've made somebody a loan for 10 years. For 10 years, I don't have my money. All I'm going to get on my investment for the next 10 years is just the interest payment that we've agreed to. And so that interest payment has to take in default risk, rate risk, inflation risk, opportunity risk, economic growth outlooks, all those factors. And I better be right, because if I'm wrong, I lose money. And so that's what ultimately, so going back to the Atlanta Falcon story for a second, yes, they haven't won a Super Bowl in 58 years, but what it takes to win is making sure I've got a great team, right? I've got to have, a great quarterback. I've got to have great linemen. I've got to have great defense. I've got to have a great, running back. I've got to have all those components together to have a great team in order to win. I got to have a great coach. So to win a Super Bowl, I've got to have all those ingredients, and I better be right. And then if I'm right with all those ingredients, I'm going to win. Same thing with loaning money. I've got to make sure that my interest rate covers all the potential risk that I'm taking by tying up money for a 10-year period. And that's what that interest rate has to cover. It's also driven by supply and demand in the markets. If I go, well, look, I'm going to be ornery and I'm going to loan money out, so I want 10% on my money. But if the interest rate environment is 5% and everybody else is loaning at 5%, nobody's going to borrow money from me at 10% unless they're really in trouble. So the supply demand within the credit markets also drives where interest rates are set. So everything else is just kind of hogwash, because there are very fundamental factors that set interest rates, supply and demand. Look, let's go back and take a really long-term view at interest rates. Now, this chart goes back to 1854. And what you see is that there are periods where interest rates fell, and there are periods where interest rates rose. And there's, of course, the one period that everybody refers to, which is in the 50s, 60s, and 70s, where interest rates went kind of tearing off to just unforeseen levels. And yes, in the late 70s, there was the oil embargo and stuff. But before that, interest rates have been rising for a long time. And there are some factors that drove that. But again, you'll notice that every other period in history, that never occurred. The average interest rate ranged from about 8% down to about 3%. And yes, there were some periods where interest rates rose, but long periods where interest rates fell, like during the Depression. So what was it that created this one period where we had this outsized rate of growth in interest rates? And more importantly, you'll notice on this chart, inflation went up, economic growth went up all at the same time. And it wasn't just the oil embargo that drove that. That was a very late stage impact of that. There was something else that was occurring coming out of the Depression era that led to this long-term increase in economic activity. And again, this is the part that everybody tends to miss in their views and say, okay, great, if we're going to have a repeat of the 70s inflation, we're going to have a repeat of the 50s and the 60s as well. And so what drove that? So again, we go back and we take a look at, as a function of what happened prior to that. So coming out of the 1940s, right? We were in World War II, and all of men fighting age were overseas. They were deployed. The women were working in the factories in the 40s. They were, you've seen the pictures of Rosie the welder back from World War II days, where the women were in the manufacturing shops. They were the one welding the Jeeps together, welding the tanks together, getting stuff to ship overseas, because all of the able-bodied fighting age men were overseas fighting. They volunteered and they went to fight in the war against, Hitler and Japan. And so everybody was fighting overseas. And of course, during that period, everything got stopped. Everything stopped in America, right? We were only just producing stuff in America. But as consumers, you couldn't get cheese, you couldn't get tires for your car, you couldn't get, clothing. Everything else was very limited because everything was being built for the war effort. So kind of everything got put on hold. Families were put on hold. Everything was put on hold during the war. So after the war was over, Johnny Appleseed comes back home again and marries his sweetheart. And you've seen the pictures of them coming back home, and they're on the docks with the Navy's docking the ships, and the sailors are kissing the women and all that. And they came home and they got married to their sweethearts. They started having families. They were building houses. But more importantly, Europe was decimated. Japan was decimated. So all of that war impact that occurred, they had to go over there and rebuild everything. So we were the manufacturing epicenter of the entire world at that point. Everything was being built here. So we went from manufacturing for the war to manufacturing for the world after that. So we had this massive boom of manufacturing activity, but more importantly, we had this massive boom in babies, building houses, forming families, creating lives. The men went back to work. The women went home, started raising families. And so we had this massive surge in the activity economically starting in the 50s. And that growth rate of activity, and again, when you take a look at a chart of economic growth, inflation, and interest rates during the 50s, 60s, and 70s, You can see this rising trend this whole time. So during this entire period for 30 years, inflation was rising because economic activity was rising. Interest rates were rising because inflation and economic activity were rising. Wages were growing during that period because you had more economic activity. People were buying stuff. They were consuming stuff. They were building houses and starting families and producing things. And then, of course, comes along the 50s and we enter into the space race and we start developing all this technology to go put people on the moon. So again, we just had this whole series of events that led to massive increases in productivity, innovation, putting people to work, creating jobs. Those jobs created more wages, and you had this virtual cycle of economic prosperity that occurred during that period. And importantly, and as I was talking about just before the break, you had no debt. The average household had about 60% of debt to their net worth versus about 130, 140% today. So households were in very, very good shape financially. And they were able to consume and grow and build families and do all those things that lead to stronger economic growth and prosperity. And you had stronger economic growth and prosperity, so you had higher interest rates because of the demand for credit, which led to corporations being able to charge higher prices because they had a lot of demand for their goods and services, which led to higher inflation. But that was okay because wages were rising. So everything worked. You had this phenomenal period of activity in the economy that led to that inflationary cycle. Fast forward 30 years, 40 years, 50 years to today. What's your driver for economic growth to drive a long-term growth cycle of inflation? We'll wrap this up on the other side of the break. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just going to wrap this up here real quick. So, a couple of other kind of big points is, big differences between the 70s and today. The debt, obviously, one of the biggest things that occurred. Back in the 60s, 50s, 70s, we had no government deficit. Household debt was very low. Corporate debt was very low. Government debt was very low. And so, one of the kind of the premises is that, well, the deficit, because, we've been doing a lot of deficit spending as of late, the deficit is why interest rates are going to go up. And there's no evidence that supports that. It's a great narrative, right? It's like, oh my gosh, the debt's going to make interest rates go up. We just have so much debt. Yeah, but there's no data that actually supports that. I've got a long-term chart of debts and the surplus and deficit of the United States relative to interest rates and economic growth. And ever since that, we have, when we were operating outside the Depression, obviously, but outside of the Depression, we've had no government debt or deficit. And when we didn't have that, the economy was growing at about 6% on average. When we started running a deficit in the 80s, ever since then, economic growth has slowed. And there's a lot of reasons for it. It's not just, you can't just point to the deficit and say, well, there's the reason, right? There's lots of reasons for that. Offshoring labor, productivity enhancements that have led to lower jobs, lower number of jobs, full-time employment, we talked about before, but also lower wages. All those type of things. And yes, recently we've had this big surge and this big uptick in interest rates and economic activity because of the stimulus, but that was all artificial. That's not sustainable. So as all of that stimulus and activity fades, economic growth is going to return back to where it exists based on the economic environment that we're in and the debt levels, right? We're in a heavily indebted economy, which really cannot sustain higher rates because of the debt. So the natural gravitational pull of interest rates and ultimately inflation is going to be lower, not higher. And again, this goes back to actually just look. So we just look at the debt, and this is what I'm talking about, is that the amount of debt that we're carrying is so large now, it just simply can't sustain higher rates. And so if we go look at the average economic growth cycle, this goes back to 1790. Economic growth was, again, outside the Depression, was very strong. But whenever we've had sharp increases in the debt, like we had funding World War II, economic growth slowed. And then once we reduced that, then economic growth could pick back up again. But again, this massive increase in the debt that we've had, particularly since 1980, has just been a barrier to stronger rates of economic activity. And if you have less economic activity, you're going to have lower rates of inflation, lower rates of interest rates. That's just going to be those, because again, as we've talked about, there's just an extremely high correlation between interest rates, inflation, and wages. And we can, we've been through this before, and again, as wages continue to decline, there's less spending power, inflation comes down as well. And that's going to be the ultimate outcome of all this. And it's just a function of how all this works. So here's, again, just since 1980, you can see this very clearly. Here's an index of gross domestic product, so that's GDP, nominal, inflation, wages and salary growth, and 10-year interest rates. And they have a very high correlation of tracking each other, again, as you would expect. And so, yes, we had this big spike in economic activity. That's now declining. It's caught up with where interest rates are. Interest rates are where inflation, wage growth, and GDP is. So now they've just caught up with each other is all that's happened. So as that wage, inflation, and interest rate environment declines, this will all start to realign themselves back at lower rates, and we'll be back to around 2% or less because of the debt at some point in the future. Now, it may not be this year, it may not be next year, it may not be the year after that, but we're going to grind our way back lower over time because of the impairments to economic activity caused by the stuff that we're doing. Artificial intelligence is going to feed right into that because it's going to increase productivity, lower jobs, lower wages. So that all feeds into it. So yes, there's some things that are certainly out there, but again, the drivers for economic activity are the basis. And you've got to just pay attention. Again, if you take all those factors, right, you take inflation, you take take wages, economic growth, and inflation, combine those into a composite index. This just cleans up that previous chart so you can see it better. You can see the correlation. So again, it's important, everybody's got a narrative, right? And, if I'm promoting, if I'm a gold dealer and I'm trying to sell gold, I want to scare the crud out of you. And I'm going to tell you that interest rates are going to go to the moon. And, because of the debts and the deficits, you better own a bunch of gold because of the end of the world, whatever. If I'm trying to sell you a product, that's what it is. But the data doesn't really support it. And that's why I always encourage you, just go back to the actual data. And look, one thing about the United States is that we have the ability. We've got tons of natural resources. We've got tons of population to produce stuff with. We can manufacture, we import, and we export. So as a country, we have a lot of big benefits that help us maintain debts and deficits that we have, right? But if you really want to make the argument that debts are going to, the debts and the deficits, that's going to cause interest rates to go higher, right? That's going to cause inflation to go higher, the debts and the deficits. Go take a look at a country like Japan, which has a 230% debt to GDP ratio. And if you take a look at their economy, it has recessions on a regular basis. The BOJ balance sheet has just absorbed 80% of the bond market at this, of the ETF market at this point. They buy massive amounts of bonds, and interest rates are 0.7%, and they just upticked recently. They were sitting at zero for years. So Japan, which is an export-based country, I mean they're very small relative to the U.S., right? Have an aging demographic, much worse of an aging demographic than we have. So if the debts and the deficits were going to show up somewhere in terms of higher rates and borrowing costs and inflation, it would be in Japan. But it's not. So if it didn't show up there, you could just say, okay, well, Japan's a microcosm experiment that's 1/3 the size of the U.S. If it didn't show up in Japan in the last 20, 30 years, what's your argument for why it's going to be different in the U.S. now? Unless I'm trying to sell you something. And see, this is the one thing that nobody's been able, when I have these debates with people, this is the one thing they get, well, this is different. The data doesn't support the narrative unless I'm trying to sell you something. And so look, I'm not telling whatever you want to believe is fine. And look, could interest rates go taking back off to the moon again? Sure. Could inflation go surging again? Absolutely. Right? If the government comes out, starts sending checks to households again, you're going to get inflation. But as of now, if everything remains status quo, we go back to a normal operating environment, interest rates and inflation are going to be lower in the future than they are today because of the debts, because of the deficits, because of the changes to manufacturing, because of the changes to productivity, because of the decline in wages, because of the incremental decline in full-time employment relative to the population, because of demographics. Those all lead, all roads lead to lower rates of economic growth. If you have lower rates of economic growth, you have lower interest rates, lower inflation. You cannot have one in isolation relative to the other because they're all correlated. They all are a function of each other. In order to have higher prices, I've got to have higher wages. I've got to have more economic activity. I have to have demand, right? Because inflation is a function of supply and demand. That's it. That's the driver of inflation. So you've got to make the case for what increases the supply-demand ratio to create higher rates of inflation. The data doesn't support it. And just saying, well, it's going to be higher because it was lower, well, I'm betting on the Atlanta Falcons this year for the Super Bowl. We'll see if it works out. All right. A couple other things here. Well, only have about a minute. Be sure and get by the website if you get a chance. Got a couple articles out from Mike Leibowitz last week, a really good one from him. Of course, while you're there, send us your questions, comments, emails. We always appreciate that. And again, we're always happy to help you out any way we can. This past weekend on our Thoughtful Money Interview with Adam Taggart, we went through about a 30-minute presentation on SimpleVisor, which is our research platform. So we're actually going to post that video to our YouTube channel this week as well. So you'll have access just to that clip. So if you're interested in SimpleVisor, you can check it out at simplevisor.com. Free 30-day trial. But we'll have a kind of a full overview video of the entire platform. We have a lot of new features coming. Managed portfolios are coming to that here soon as well. Lots of thematic portfolios. So hopefully in the next couple of weeks, we'll have those portfolios up online also on simplevisor.com. So anyway, lots of great tools for you. Be sure and like and subscribe to the channel. We certainly appreciate it. Send us your questions, comments, and emails. And most importantly, hey, it's a holiday shortened week, so you get a holiday right in the middle of the week for no reason whatsoever. But there you go. All right, have a great day. We'll see you back here tomorrow with John Penn, talk more about markets, money, and what happens today. Don't go away.